Most investments carry risk, but there's one that is all upside. The only risk-free investment is an investment in yourself. The Globe and Mail is the largest business newsroom in Canada, interpreting and unpacking macroeconomics, housing, policy decisions, and world events. Enjoy a comprehensive suite of business newsletters, breaking news, and market updates straight to your inbox. As a subscriber to the Globe and Mail, you'll get access to investor tools like advanced charting, portfolio with the Wealth Scope report card, providing an independent 6-factor review of your portfolio, and stock screener to help you find the right investments. The Globe and Mail is offering a special digital subscription rate just for Loonie Hour listeners. For a limited time, get access for $75 a year for your first year. For more details, visit globeandmail.com/podcast.
Before we get started, I just want to remind everyone that this information discussed today is not intended to be or construed as investment advice. Please consult a professional advisor before putting a loonie in any of these financial markets.
The dirty secret is that no one's ever going to get paid back.
People have the shortest memories when it comes to investment.
We just got to get Keith into Bitcoin.
Hey, there's a bubble. Welcome back to the Loonie Hour, episode 72. As always, joined by the three amigos. We got Keith Dicker of IceCap Asset Management and Rich Diaz of Acorn Macro Consulting. Welcome back to the show, gentlemen. What's shaking, Keith?
I got nothing shaking. I'm here in Halifax. We've had snow 3 times this winter, and that it evaporated a day after. I think all the ESG funds are soaking it up. Rich.
We'll get into that later. What's going on with me?
New flowers in the background.
I've got more flowers. I bought some flowers for me. Well, it's not Valentine's Day or Valentine's Week. I'm addicted to history podcasts, and I've basically been just consuming them and gobbling them up. You know, a long time ago, someone told me to read the book Investing: The Last Liberal Art, which is a very popular investing book. And in that book, the guy, I can't remember his name, you can look it up, he insists that understanding psychology, science, engineering, and especially history is very, very, very important. And I took that to heart, perhaps a little bit too much. And for some reason, the last couple of weeks, I've just been devouring everything to do with, China, Portugal, the Colombian exchange. So there you go. That's my nerdy. Clearly, the dates aren't going well if all I'm doing is listening to history podcasts.
Good. Is that a good book on sentiment?
Which one?
The one that you just talked about.
No. It's about, like, if you're going to understand investing and cash flows and risk reward, then understanding a little bit about psychology, history, obviously math and statistics, but like engineering and science are very, very helpful in having sort of a lattice work approach to investing and trying not to make mistakes and hopefully making some money. And it's a great book, Investing: The Last Liberal Art. I would definitely recommend it.
How the hell are you single? I don't get it, man. or maybe I do get it. We'll see. Another suggestion for you, Rich. Maybe you can go on a dark retreat. Did you guys see that story this week? Did you actually
dark
check
retreat?
Out?
What is that?
Yeah, your boy Aaron Rodgers.
Yeah. Aaron Rodgers, he won this. It's now the guy that runs the business. It's in rural. He's in Oregon.
I thought it was in Asia somewhere. Okay, sorry.
No, it's Oregon, and which, by the way, if you've never been to Oregon before, it's a different world. I was out in Oregon a few years back. We had a nice little place on the beach. Their beach is gorgeous. Like, the whole length of the state is all public property, all beach. But I had a pint with Tom Selleck once. I think I told that story once before. But anyway, Aaron Rodgers did a dark retreat, so you can find it online. And this guy set up a business where basically he's done up these little small cottages or rooms that you hang out with yourself, and you can make it a complete blackout, and you just get to know yourself a bit better and make some decisions. So, Rich, that might be something for you. This guy's business is booming. I think it's over like 150-day waiting list to get in there.
Well, I can't do the podcast from there, so sorry. It's a strike one.
No, you can. They'll give you opportunities to come out if you want. It's not jail. You can do that.
So,
Steve is
Steve,
not
get us
down with
going.
that. Steve is like, what the heck? That makes how can
yeah,
you
I don't know
sell
what you
real
guys. I
estate
don't know what you guys are
from
talking
there?
about, but Keith, there's been increased activity in the extraterrestrial activity. I know we talked about UFOs, balloons being shot down last week. There was a 4.9 foot sphere that appeared on a Japanese beach. Police have surrounded it. Another flying object has mysteriously landed on a Japanese beach that is making front news headlines. So for all you conspiracy theorists out there, Keith is devouring this one.
You know, one of my favorite movies is the original Planet of the Apes. You guys seen that? You get
Yes.
the punchline at the end. That's what the Japanese beach photo looks something like.
Oh God.
Yeah, it was good.
Let's move
Okay, what
on.
else we got going on? And speaking of like UFO stuff, you know, all of a sudden the Fed, you know, they're in a new world again. It seems
Save
like.
us, Steve.
Well,
Tell us.
yeah, we're gonna get into that because I think you know, a lot of the excitement at the beginning of the year was that inflation's coming down and you know the Fed's gonna, you know, Bank of Canada, the Fed, they're gonna have to start cutting rates and so we're obviously seeing a lot of data, a lot of anecdotes, a lot of stories that are coming in saying, hold on a minute. So we're going to get into that. But I think we do have to touch on maybe the one good data point that came in last week. That was Canada's CPI inflation numbers coming in below expectations. So I think it was headline inflation, I believe, was 5.9% on a year-over-year basis. I think economists' expectations were about 6.1. So this is certainly a good number for Tiff Macklem after, you know, really seeing, you know, crazy high jobs numbers over the last several months, a reflation. But Rich, I don't know if you have, you know, if you want to unpack that. What I found interesting was that, I mean, I'm sure we'll get into this, was the bond yields really didn't react at all. So clearly they just kind of poo-pooed the news, the good news, I suppose, and just kept on. So, Rich, what was your takeaway there from CPI?
I mean, maybe the bond market is just focused on sort of the jobs numbers rather than the inflation numbers. Who knows? On the CPI, I think there's just like three things I like to order stuff. One is food inflation grew 1.1% month over month, which is it doesn't sound like a lot, but month on month, if you annualize that, so whatever 2 times 12 is, you know, someone smarter than I can figure that out, is a lot. And it's the highest month on month change or increase in 15 years. So the last time was, I think, November 2008. Someone will correct me if I screwed that up. That's a huge increase. What's important to note is that food is 16% of the Canadian CPI basket. The problem with that is that if you're a low income family, you will spend a higher proportion of your total consumption expenditure on food, electricity, gas, heating, and the second largest increase was energy. So it was not a good month if you were a low income family. The second thing that I thought was really interesting, you'll like this, Steve, which is the shelter component, my favorite, which is 39% of the core CPI basket had another, it still rose month on month, but just barely. And its contribution, so the weight times the number, is starting to roll over. And so that's really, really important. And then my favorite, of course, is the 3 preferred measures of CPI, core CPI, which of course was ignored by the BOC and friends. And all 3 seem to have peaked. They're still quite high at 6.6, 5, and 5.10, but they've definitely seemed to have rolled over. The idea that any of those core measures are going to get back to 2 before the end of this year is just bogus. It just doesn't make sense. But it's really interesting. And yeah, so we're getting there. We're getting there. I think it'll take longer than people expect, but we're getting there. That's all I got for on the CPI.
So the BOC's preferred median and trim inflation measures are now running at about 3.5% on a 3-month annualized basis. So they have a target range of inflation between 1% to 3%, right? So we're at 3.5. So I suppose they're getting closer to that range, but.
Yeah, well, can I give myself a shameless plug? It's free on my Substack if you want to see every month. I'll write up a little bit of a note and throw in the charts that I think are the most important. I try to write it in an easy way, but you can check it out. But yeah, you can see those charts that I talk about, and yeah, comments welcome.
What about speaking on your food groceries? I found it interesting. Loblaws actually reported today. So Loblaw is saying that the company fourth quarter results beat analyst expectations on Thursday. The company says it earned a profit. Fourth quarter revenue rose 10% from the same period last year. So I'm assuming those revenues are obviously not inflation adjusted. So if you had food prices are up 10%.
Well, on the quarter, I mean, the reality is Canada is the land of oligopoly, right? We have an oligopoly in grocery stores, we have an oligopoly in telecom, and we have an oligopoly in banking. We probably have an oligopoly in oil and gas. And each of those sectors has outsized margins from other comparables. If you look at other countries, and higher ROEs, if you return on equity, if you look at comparables from other countries. So the fact that Loblaws is doing really, really well when Canada's food inflation is 10 whatever percent, I'm not surprised at all. They have no incentive to pass that through to the consumer.
Inflation on utility companies too.
Yeah, probably. But utilities are normally like a natural monopoly, and they're heavily regulated. But anyways, it's just. Anyway, so I'm not at all surprised by that, but I don't see food inflation going down at all. It's partly to do with the shortages. It's partly to do with high energy prices and the cost of heating greenhouses. I know that's happening in the UK. There's shortages of salad and tomatoes and all kinds of stuff directly related to the cost of natural gas. These companies and greenhouses that run these growers usually use greenhouses to do it in the northern climates, and they just don't find it economical to run these businesses, so they just basically shut down, and now there's no salad and tomatoes in the grocery store. But we all know that you don't make friends with salad, so there you go.
So
you don't make friends with a salad?
You do not make friends with salad. This has been well documented.
Which food group do you make a friend with?
Pork. I don't know. You don't make friends with salad. I cannot wait till you get absolutely crushed in the comments for this, Keith. This is a classic Simpsons episode where Lisa wants to be a vegetarian and Homer tells her that you don't make friends with salad, so there you go.
That is a good point. Keith, you have pizza nights at your chalet there every Friday, don't you?
Yeah. We do. I'm getting geared up for another one tomorrow night. It takes 48 hours to make proper dough, by the way. You need a cold fermentation. Rich, to comment on one of your points, you talk about oligopolies there. You forgot there is a monopoly actually in Canada for quirky and socially awkward economic global macro podcasts. So I think you forgot to add that. That's a shameless plug as well, right?
It is a shameless plug.
But trying on though,
I love it.
Yeah, there's nobody wants to go on the ice with us. Well, I take that back. I think a lot of people would. But with us though, I mean, we'll tie into it as well here. But with financial markets, January was a pretty good month, especially for a lot of the equity. Different parts of the equity world, that got hit pretty hard last year, like the NASDAQ, theme type stocks. And then all of a sudden, things are rolled over here in February, but agricultural commodity markets have not. So we have a good exposure to that market, and it's really smoothed out our year already with that. And again, so just to suggest to everyone, you always have to think beyond the whole, stock bond world. That there's always opportunities everywhere, but we've highlighted, the commodity space, specifically agricultural commodities and the energy sector, to be, bottoming here in 23, and we have a real nice opportunity as the year goes on. I'm not quite sure it's happened yet, but again, it's a good example for investors. Just look at everything, right? It really is a big market out there.
Rich, I have a question. I remember when we started this podcast over a year ago, I think it was like in the early days of the podcast, we were, joking about CPI inflation, and, it was being underreported at the time because of these lag effects. And, one of the ones that we kept highlighting was like Stats Canada had like food inflation at like 2.3% or something, some egregiously low number. And we're all like, oh my God, man, like, have you been to the grocery store lately? Like, it's so expensive. And, obviously food prices have not come down, but I anecdotally feel like they've moderated So I guess, I'm assuming this is another one of those like it's lagging. Don't expect it to come down. Like steak's never going to be, what it was pre-pandemic, but likely seems like it could peak out soon. Or what's your thoughts on that?
So that's a really good point. So I said food, but food's actually made up of different categories, and that's important. Food is food away from home, restaurants, it's groceries. Obviously it's takeaway, it's like fast food. So I'll read you the components. There's only 3 of them. It's table service, so restaurants, from stores, so grocery stores, and then fast food and takeout restaurants. And the one that's really jumping is from stores. The grocery component is actually 11.5 or 11.4%. So there's 2 parts to the answer. One is, these indices are always sort of misleading, but 2 is, I challenge anyone to come up with a better way of calculating, which is what I'm sure I said a year and a half ago, which is like you have to be sort of gentle with these indices. Like, yes, I know there's a lot of anecdotal to say that it's higher or lower or whatever it is. I don't think it's moderating. I think that's the upshot. I don't think it's moderating. I think what you're seeing is the fast food is continuing to accelerate. Table service is continuing to accelerate. I think I posted a job that said combination hotels employment is well below long-term average. I think that has partly to do with it. Once you lock down an economy and you fire all these service sector people, dragging them back into those jobs is going to take a significant pay hike, and that's going to translate directly to the ability to the prices restaurants have, their margins, etc.
It was a brilliant idea, was it, to shut down the economy?
I mean, let's not get into that, but I would say you're right.
It was the government. The government did it. Now they're sending us UFOs too. Come on, guys. It's right in front of you. You got to see it.
Oh God.
Now,
I mean, I don't know, Steve. Maybe you're right. Maybe anecdote, maybe it is moderating. I'd love to hear people's views on that.
I mean, I'm looking at it like kind of big picture. I'm like, okay, so you've got food inflation running at double digits. Maybe it's moderating, maybe it's not. Shelter inflation came in up 21%, highest since mortgage interest costs the highest since 1982. So the 2 things that people can't live without, which is housing, shelter, and food, are just through the roof. And so I have to think about what are the political ramifications of this. Like, I don't know. To me, that seems like a pretty solid recipe for social unrest.
Yeah. Add in housing. Did we talk about that? Or is that 3 or 2, Steve?
Housing, shelter, food, the 2 things you need to survive.
Oh, if only Shirley knew.
I mean,
yeah.
But the other thing that's tied on to this now, though, I mean, obviously everyone is, we're all very well aware of prices are going up on everything. We're in the investment world, so we look at it a bit differently than other people. But the reaction to it is now happening everywhere. So labor unions, they want big increases, and justifiably so. They're saying, hey, we need more money to live. But we're going to see taxes start going up, and one of the stealth taxes, of course, is in the housing market. They'll say, oh, we'll keep the property tax at the same rate, but they reassess everything higher. Or if you live in Vancouver, they're just outright going to tell you that they're going to, what was the story, Steve? They're going to raise.
Yeah. So the city, this, Vancouver's not the only one. I think Toronto came out correct me if I'm wrong, but I think Toronto came out more recently saying they'd have to increase about 7%. But so the city of Vancouver has come out and they proposed a 9.7% hike in property taxes for 2023. And they've warned that an average property tax increase of 8.6% will be needed between 2023 and 2027. So, massive shortfalls. And I'm assuming, Keith, correct me if I'm wrong, but I would imagine that the forecasts or the budget that, these municipalities put out is probably predicated on, relatively stable housing markets, right? I mean, if housing starts continue to roll off and these municipalities can't collect their development fees for new housing, or again, it just, to me is it's interesting. I think that the squeeze is on for these municipal budgets.
Well, there's a couple of things with it. I mean, so first of all, the problem here is that the world needs more money, right? That's what it is. And the solution is just creating another problem. So their solution is, we'll just take it from you. We're going to tax you. We'll take that money away from you, and that will solve my problem. But yet it leaves you with a hole on your income statement or balance sheet if you're living, on savings and stuff. So I don't, again, I keep going back to the world is synchronized now with risk. Like something is not quite right. It doesn't look right, feel right and smell right. And you go back, this again is just the next stage of this with, in terms of how cities, municipalities do their budgeting. They simply look at it, they see what their expenses are coming up. And I don't think any of them are very good at cutting costs. Like if you're a small municipality, I don't think they have a lot of wiggle room on a lot of their costs. I mean, I think they have to pay for snow clearing, everything else they're, providing, to residents. And if they have a shortfall, they have to make it up. They're not allowed to run a deficit usually. So then by default, they have to raise taxes. I mean, and again, it's tax. So if you're like the biggest, one of the taxes that drives me nuts, and it makes total sense. If you're going to a big city and you rent a hotel room, if we were stay, all of a sudden is because you're not a resident there, you're paying all this room tax, the city tax, and another tax for this or that, because they're thinking, man,
$1.
You don't live here. We're going to just take it from you as much as we can. But then that takes money away from you to doing something else. Again, we're back to this same theme in that we have all of these small micro challenges, financially, economically. But if you bring it up to an aggregate level, from a macro level, it doesn't reconcile here. Like something has to get adjusted, which is debt, right? Debt has to get adjusted at some point.
There's another angle. Oh, sorry.
Did you guys see? You've got this, like, it's interesting, right? I'm just looking at it again, like we try to sort of steer away from politics, but you can't help but talk about the politics of this because people naturally, again, we see that their shelter going up, the cost of owning, the home that they bought 15 years ago going up, their grocery bills going up, and now their taxes are going up, and it's interesting, right? And the solution to all of this, I don't know if you saw it out there. There was an interview with Trudeau the other day saying that, a lot of our systems are under pressure, but, we're going to bring in all these people and they're going to sort of help fix these issues. But like I said, it's interesting because it's like, well, I just think there's animosity growing because people are like, well, this isn't getting fixed. It seems like it's getting worse. And there was an interesting article out last week I just thought it was noteworthy because it was from CIBC's CEO, Victor Dodig, who came out and said that we're on the path to creating a social crisis in this country, which is you're going to welcome, last year we added 850 some odd thousand people to the country, and we don't have the infrastructure to support these people. We're going to bring in 1 million people in 2023. And there's no housing plan in place. In fact, housing starts are falling off this year due to the obvious nature of what's happening in financial markets. And so, I found it interesting that the large Canadian bank CEO, who arguably profits,
definitely profits off that.
Definitely profits off more people coming into the country so they can sell mortgages. Came out and said, "Hey, listen, you're engineering a social crisis."
So, I mean, the one word that just is never talked about enough, and it just should be at the top of every politician's mind, is productivity or productivity growth. And it's just, that is the way that you can square the circle, right? If you just become a more productive economy, if huge debt burdens can be dealt with if you become more productive as an economy. And the way that one becomes productive as an economy And Canada is decidedly does not have good productivity growth. If you rank 30 or 40 OECD countries between 2014 and 2019, Canada was the 4th or 5th worst OECD country in terms of productivity growth. So let's just get that straight. The way that you do that is you invest in research and development. You build high value added industries. Believe it or not, refining oil might be one of those. And you can improve your productivity growth. And that is one way that you can get yourself out of a debt burden. You can deal with more expensive, services and goods, etc. The problem is we just spent the last 15 years misallocating capital. Sorry, Steve, block your ears, into real estate. And our research and development spending as a percentage of GDP is at a 25-year low. And so that's the mess we're in. That's what happens, when we don't prioritize research and development, we shy away from the sectors that should be, given money, and we allocate to your industry, Steve.
But right, no, and I agree. Let's call a spade a spade. Like, what the economic model seems to be for the country is add more people, bring in immigrants to basically pay for, Social Security, all that other stuff that's going to have massive shortfalls down the road. So bring in all these people, and they'll basically take care of all the old people leaving the workforce, and we'll build them housing. We basically export housing, right? Like, ramp up as many people as you can, bring them to the country, build a bunch of condos, put them in there, and that's sort of the economic model that we've been driving. So
it's a tough one, guys. I mean, it's we know what the challenge is, but the solution, it's tough. I mean, from a demographic perspective, we have to grow the population, and you want it to be a younger population. Otherwise, it just collapses over time. And I think there are a lot of countries out there right now that are on the verge of the slow motion collapse, as well as China. China's demographics are horrible. And meanwhile, I think Mexico is fantastic. I think the Americans have really good demographics as well. I'm sure one of the Fantasyland countries might look good. I don't know which one, but you never know. There's a bunch of them out there.
France has excellent demographics,
but that's probably from immigration, though, I would imagine, right? Yeah.
It definitely has its positives, right? Like, don't get me wrong. I just think I think everything is maybe in moderation. Right now, there just seems to be just keep pushing the targets higher. And like I said, it was funny because I was at a housing conference today, and all the real estate industry types, they love it, right? I mean, it's just like, great, bring them in. We can build and sell more condos. It's fantastic, but it's the reality is it the best thing for the country to have sort of a seemingly unlimited target? I mean, we can go on and on about this. You don't need to get into the politics.
But the good thing with this, right? And I'm not a believer in a centrally planned market, no matter what you're looking at. And so if you do it the way that we're doing it in Canada, and by the way, it's not a strategy, it's just the way it's developing, right? It is what it is. If you let the economy work the way it should, success will be rewarded with more success until ultimately it gets to a point where it's been inflated, and then you get failure. But this is where the West has done a very poor job, is that they've actually rewarded failure over the years. But they don't let important companies and industries go under when they should go under. There should be a loss there somewhere. So if you never let anyone take a loss on a bad loan, you're able to tuck it away forever, then guess what? It's going to be out there forever. It'll continue. And if you're penalized as a small business owner, and this drives me nuts, small business owners, they take on so much risk, they work so hard, and apologies to people running the salary jobs, with the 35 hours a week, 37 and a half. I don't know what it is.
We're going to a 4-day work week now. Did you see that study in the UK?
Oh, for God's sakes. I'm not finished. I'm on a good roll here. But if you're a small business owner, you're taking the risk with your own capital. You're probably working 60, 70, 80 hours a week, and you're just grinding, and you're not getting the support from a social network that other people are. And so it can be grinding, right? And those people taking the investment risk, the business, they should be rewarded, whereas other people are not. I'm not explaining this properly. So the way this gets resolved is that it just becomes untenable. At a point, it will reach that point, where something does break into. Rich, that's a good snap, right? There you go. Got Rich's attention. And that's the way this will get resolved, right? But when the day comes, the policymakers have to say, yeah, you know what? You're a manufacturing firm in one of the Canadian provinces that always gets bailed out no matter what. We're not going to bail you out this time. If you're somewhere else, you have to let it work. And I think that's what the solution is. But to be a politician and let that happen, it's a bit tough, guys.
Takes guts.
So speaking of,
go ahead.
Go ahead, Rich.
No, I was going to say, just to support Keith's argument. I mean, I'm looking at the numbers right now. The number of self-employed people is the same as it was 10 years ago, and the number of people working for the government is up 20%. That does, obviously, private sector is up 15%, but just to show you like where the priorities and where like the market is, show me an incentive and I'll show you a result. And it's just actually remarkable. I'll share that chart in this week's Loonie Hour Substack. But sorry.
Speaking of which, there was actually it was a decline in active businesses in Canada. So a drop in full-time jobs. So the number of active businesses versus full-time employment that ticked lower for the first time since the onset of the pandemic. So perhaps maybe these interest rates are finally starting to bite, and we're seeing more businesses closing shop. Yeah, in this country. So interesting. Again, obviously, if you're looking for an uptick in output, might be waiting a while.
And by the way, if you are a government employee, whether it's provincial or federal, your job is safe until the day comes they can't, sell their bonds. Basically, they can't raise more money. And that's when the provinces and the feds have to say, oh, wow, we now need to reduce our spending and stuff like that. But I'm not seeing any sign of that right now. That's still, it's a bull market right now.
Tomorrow's
government borrowing. That's tomorrow.
Well,
people just want some homes. Just let them live.
Speaking of which, obviously, Fed doing what they're doing. It's been one of the worst bond market routes. I think in recent history anyways. But there was
since 22.
Quebec fund was slammed by the bond rout in worst year since 2008. So their fixed income portfolio declined 15%. Huge announcements. Keith, I think you were tracking that one. Do you have any thoughts on that? It's Canada's second largest public fund.
Yeah, I mean, that's expectation. That's what that number shouldn't surprise anyone. I mean, duration lost money and credit lost money as well. Like there was nowhere. The only place to hide in fixed income was to not be in fixed income. So that, I mean, it was a tough year for that market. What caught me though with that story, it wasn't their fixed income return, because remember when these guys when they speak to the media or they release report about the performance, you have the negative stuff, but also the positive stuff. And I don't have the article in front of me, but I remember that the gist of it was, but our private equity, it did really well. It was up 2% or something like that, I believe. And that's what catches my eye. And I sort of chuckle at it. Because do you remember during the Toronto Lab event? Maybe not. Yeah, you guys I was there. I had fun. But I remember I was chatting with a guy actually walking through the pedways to the event, and he worked on the private equity side for one of the big provincial pension funds. And he said, "Yeah, it's kind of tough in that space. So how are you marking it? Like, are they marked to reality or fantasy?" And he said, "Oh, fantasy, of course. We're not taking real marks on this." And he said, "And we don't have to, because like they'll never have to sell it like for generations." So when you see the this article from the Quebec pension fund, so yeah, we lost a lot of money in the bond market because that's marked to market on a daily or weekly basis. They can see it, they can't hide that. And then the part of the portfolio that they did really well with, it's because it wasn't marked properly, and that's it. So I suspect a lot of these funds that their actual performance was a lot worse than what they reported. But what people don't realize with defined benefit pension plans, there's two sides to the coin.
You stole my point. Go.
Coins? No.
Go
ahead, Rich. You need
no,
help
you do
every now
it.
and then
Age
on the
before beauty.
podcast.
Age before beauty. Age before beauty. Keith, tell us.
Definitely age. But with people don't realize with pension funds, they have assets and then they have liabilities. So when interest rates, say long-term interest rates go up, it means they lose money in their bond portfolio. But the way it works from an actuarial perspective, when they're calculating their liabilities, because they're using a higher interest rate to discount back the liabilities, from the future to the present, they have less liability. So a lot of these plans actually have gained money on paper, on net assets. It's a funny game, guys. So these pension funds, don't get lost in the headlines and everything that you'll see in the media over the next few weeks as the numbers are coming out. The bottom line is their investment portfolios lost a lot of money, and their liabilities have come down because rates have gone higher. But I've had this conversation with a lot of funds over the years, and they always say, yeah, that's the way it works. It's awesome. You don't have to worry about it. I always say to them, well, what if you get permanent losses on your bond portfolio? And that's when they look at me, like with five heads, that will never happen. That's impossible. It's almost like a bank not paying their dividend or cutting back their dividend, which I got into trouble with this week on Twitter, even suggesting that might happen.
Isn't that just an awesome day? Isn't that just when the Bank of Japan just comes and soaks it all up?
Yeah,
pastes it on their balance sheet.
Yeah, I mean, they're warehousing everything right now. But if you get a permanent loss, then it's the whole pension structure doesn't work anymore.
There's another reason why a lot of these so Keith nailed the asset liability point just spot on. He's a CFA and he's a great investment manager, so he beat me to it. Good for you, Keith. But there's another reason why these pension funds lost a lot of money the last couple of years. They were not invested in oil and gas and energy because of the scam that is ESG. And what's really funny is that the chickens are coming home to roost. Is that the expression, Keith? On ESG. And it's something we talked about, we touched on in Toronto. It's one of my 5 themes for 2023. And I think, we discussed different reasons why it's bad, whether it's a labeling issue, whether it's charging people and effectively lying for what they're getting issue, whether it's a performance issue. But one of the main reasons why a lot of these pension funds did really badly in 2022 is because the best performing industry and subgroup was oil and gas and energy. And I'm willing to I'm not willing to bet a Twinkie on it, but it will be one of the better performing sectors this year, again, because of stuff we've talked about on this pod, which is there's not enough supply and there's zero capex, but demand's not going anywhere, et cetera, et cetera. But so it's a really interesting wrinkle that I just think is delicious. And whether it's in Europe with the recent labeling fiasco in the EU, whether it's the Texas Attorney General and the Florida Attorney General and several other states in America that are starting to push back on the issues with fiduciary duties and not actively allocating assets and resources to the right sectors, and basically, not fulfilling their promise as investors for allocating the capital in the best way possible. ESG is absolutely having a reckoning, and that's one of the reasons why pension funds did badly this year.
Hey, Rich, in the future, what do you? It's a serious question, unlike most of my other questions, right, Steve? What do you think the future history books are going to be telling us about this period we're living in right now with ESG and all that? What are your thoughts on that?
I think it'll be seen for what I believe it is, which is just basically marketing. It's just a way of extracting fees for dubious claims on performance. And the beauty about markets and why I love them is that eventually you get called out. whether it's long-term asset management capital or whatever. I just screwed the name up.
FTX.
If you know what I mean from, FTX, whether it's the AAA rated mortgage-backed securities that were total gobbledygook, whether it's Madoff, whether it's this or that, eventually the market will find you out and expose you. And I think for people who are obsessed with ESG, I just would suggest that people should always be quite dubious of quote unquote financial innovations, no matter how they crop up. They should not be taken at face value ever. They should be doubted. They should be investigated. They should be scrutinized, as your fiduciary duty, Keith, and my fiduciary duty as an investor compels us to. And eventually, I think that it'll just be a wash. I think people will sort of forget about it and pretend as if it never happened. And a lot of the key tenets, I think, will matter. So people will be very cautious about whether or not companies care about the environment or care about the standard of their labor practices or care about corporate governance. But that was true before ESG. Any analyst who was this bottom-up analyst worth their salt, if you were analyzing a company, you were looking at the risks of environmental disaster, if you're an oil analyst, of labor malpractice, if you're a clothing and apparel analyst, of if you're buying Tesla, you absolutely care about the governance practices of a company like that, or Tata Motors, or Diageo, or 100 other companies that are run by families and have suspicious corporate governance practices. And any analyst who was doing bottom-up stuff would have been analyzing that anyway. The bullshit factor is that it's aggregated, it's detached from the people who actually are affected by this, and people are just given a number and they throw it into a machine and they charge an extra fee for shit performance. And so I just think eventually it'll just be forgotten. I think that would be that's my hope. Maybe I'm too biased on this, Keith. I'm sorry.
We're going to have to get a new segment on the show. Rich talks ESG. And just let him spiel for an hour.
I know, like he can just go on and
I'll be
on.
quiet for the rest of the show.
Not bad.
No,
what other thing?
Go
you
ahead,
want to talk
Keith.
about the ESG, Steve? Or
Well, no, I was just going to wrap up the whole Quebec pay. So however you guys want to calculate it, they said they had a loss of 5.6% last year. I'd also like to add that these guys were the ones that invested in Celsius, which is the crypto banking company that blew up. So these guys have had a pretty tough year, the old Quebec pension fund. I apologize to anyone that is working there. No disrespect, but tough year.
One other thing, just to add on with Rich's thoughts. I think this is a bit different though. And what's different this time? I love those words.
Oh yeah.
It's always like, here he goes. This whole ESG view, it's in our culture now. It's all at every single government level, at all corporate levels. It's in universities. So I don't think it's as specific as, hey, it's an investment idea that bad performance will. Because I don't think these groups care about the performance. Truthfully, I don't think they were more about let's get it right. And so it's going to take a while to get this filtered out. But the way it does get filtered out is when you do have active investors. So I think, Rich, you mentioned, was it Texas and Florida you mentioned earlier?
Yeah.
I think.
Yeah.
And I'm sure there's other pension funds out there as well as institutional money, and they're deciding, you know what, we don't agree with this and we're yanking our money. So I think that's what will lead it to change. But until then, no, we have this underlying culture that's building up. So Richard's view, which is very sharp, by the way. And by the way, everyone, I think if people don't know us well enough, we all carry a stick around, and whether you like it or not, I think all three of us have both ends pointed pretty good, right? We're not afraid to use that. But I think Rich is on to something with this, and he's been very consistent with it, and that this will change over time. But it comes back to this whole, hey, do you believe in capitalism or socialism? I think that's really the theme earlier. And the P&L, the profit and loss, that should win out over time. So we'll see what's happening. So I know BlackRock, for example, they're really struggling with assets now in the ESG focused funds and so forth. But this is the I happen to think there's lots of great opportunities come up in the energy world, and we're looking forward to.
Oh, sorry, Keith. Sorry, Keith. I didn't mean to interrupt you. I just want to say one more thing is I think that people need to understand, like, I'm in contact with a lot of institutional investors on a daily basis. They're my friends, they're ex-colleagues, they're clients. There is not one person in my sphere that thinks it's a serious thing. The dirty secret that I think everybody should know, and maybe this podcast is not the best way to tell everybody, but too late, is that nobody takes it seriously. It's all a wink, wink, nudge, nudge. There's not one person who I know who is I've been in this industry for 15 years. I have loads of contacts, friends, bosses, ex-colleagues, etc. Everybody thinks it's BS. And I think that eventually you can't keep a lie that big, that obvious under wraps. Eventually it gets exposed.
Well, speaking of, I think that's a good place. I think, speaking of lies, I think we should chat about another lie here, which is
not the UFO, not the UFO.
We've already covered that. I'm very concerned. Fed staff, now talking about a potential, are we going to get back to 2%? I think that's now been bumped out. There's a lot of more projections coming out and saying, okay, well, hey, oops, it's actually going to take longer to get to back to this 2% inflation target. There was an article the other day, which Jack Farley put out, really good follow on Twitter, where he says the potential new Fed chair, which is Janice Eberly. So she co-wrote a paper in 2019 that found that a 3% inflation target by the Federal Reserve would have actually led to a faster recovery out of the GFC. So there seems to be a lot more institutions, reports, papers coming out and saying, well, should it be a 2% target? Should it be higher? And I think the challenge is certainly going to be, yes, inflation's coming down. Can we actually get it back down to 2%? I don't know, Keith, if you have any thoughts on that, but clearly markets are starting to readjust their expectations.
Yeah. So first of all, I think the success that central bankers have claimed over the, pre-pandemic, over the previous 2 decades, they achieved it for reasons that weren't created by themselves. You know how some people can say everyone's their own sense of their self-worth is higher than what it is in reality.
Not you, of course.
No, yeah, I have pretty good self-esteem, if you know me. I'm not lacking in confidence. But with the central banks, though, like if you look at the O's and the 10s, there are a lot of other factors that contributed, to that happening. And a lot of it, when you get the breaking of a debt bubble, which happened in a mini way with the tech bubble breaking, and then the housing market breaking 08 and 09. When that debt bubble breaks, man, that just sucks the momentum out of prices everywhere. And they misattributed inflation being low during that time frame to their own skill set. And then all of a sudden, prices are going, they're up a little bit right now, as they would say. And that, of course, was caused by, we keep going back to it, we dance around it, but it was caused by the global shutdowns and the policy responses around it. So for them to believe that they're going to be able to control inflation by changing the definition of inflation, I mean, come on, guys, that's a bit weak if you really know what's happening here. So I think that answers maybe the first part of the question, Steve, and I forget the second question.
Well, yeah, I mean, I think, was it now for the first time in a while now, markets are actually pricing in a higher Fed funds rate than the Fed is projecting. So I think the whole time the Fed's been kind of ahead of the market saying, hey, we're going to do more, and the market's not believing them. And it seems the market's saying, okay, maybe you're right, and maybe you'll actually have to do more. So there certainly is a bit of a concern that inflation is maybe reemerging, or is going to be more challenging to get down, just given the, I think what we've talked about on the show, right? Ongoing labor supply constraints and just things that might be structural in nature, such as energy markets.
I mean, so right now we're right. Think about. I mean, we touched on it briefly there earlier today. January was a great risk on month again, and I'm chatting with people. They're like, "Oh yeah, we're back off to the races again. We're back onto the races, and it's going to be great." And then what people may not realize though that during January, the institutional guys didn't really jump on this rally. There's a lot of retail investors, money following it. And now it's rolling over again. And now the narrative is right back to where we were last fall, in that the Fed is hiking rates. They're still hawkish. The long bond is selling off again. Long duration assets are selling off again. So we're sort of right back. And the dollar now, all of a sudden, the wrecking ball is back in full swing. And this is the environment that we were anticipating would happen, and we're just getting back into that now. And maybe the low was reached yesterday, right? We'll see here. But if it continues like this, we'll continue in this environment where there's a really great opportunity for some risk somewhere, to bubble to the surface. Maybe it's a big steel ball on the beach, or maybe it's something else. But it's something it's out there, guys. You can just feel it.
Alien invasion insurance.
My God, you should sell that.
Well, it's a lot brewing up these days. We've got Canadian banks set to release some earnings here. I think TD, Keith, I know you've been monitoring that as well.
Yeah, Canadian banks are finally coming out with their, I say finally, they do it every 3 months, but we've been waiting now for a while for this stuff. And I love bank earnings. The income statement, the balance sheets are the best thing. Do you remember Enron by any chance? Where you guys were too
Arthur
young
Anderson?
back then?
Is that
they were hanging out then. Yeah,
there's a
absolutely.
Netflix show about Enron, I believe. I haven't actually seen it. I heard it wasn't that good, but it is on Netflix.
Yeah, you never know what angle they take with it. But the cool thing with Enron, I remember I was listening to the analyst call when quarterly earnings when it came out, and the CEO, I forget the guy, was it Ken Lay, or was he the?
Sounds right. That sounds right. I'll look it up.
Okay, and anyway, he was going on about their earnings, stuff like that. And this analyst, I think he was with Morgan Stanley, and he asked the question. He said, we haven't seen your balance sheet for a while. Do you mind sharing the balance sheet with us? And the Enron CEO did lit into him. I mean, the guy must have felt like yay big when it was over, and that's all everyone was talking about. And finally, people realized, geez, they actually haven't given anyone a balance sheet, forever. We have no idea. And that's the thing with financial analysis. Most investors and in the media and retail investors are always focused on what is the earnings growth, what's revenue growth. But you can do a lot of things on your balance sheet to help out your income statement from time to time. So back to the Canadian banks. I'm not suggesting they are doing any of that, but the financial sector it's the best sector or industry in the investment world where you're allowed to basically create smoothing accounts to do things. And there's no other way to really resolve it, right? Because, they're investing in long cycle loans and assets and everything. But so right now the banks are going to come out. Everyone is going to the earnings will be awesome. They always are. They're able to do that. But they're really going to be focused on what's happening on their loan loss provisioning or provision for credit losses. I'm old school. I use the first one I described, but we're going to see that coming out, and we'll get to see. And the whole thing is going to come back to whether we have a recession or not in Canada, because they're still playing the soft landing here. So I think it's the 28th. We got the first one coming out, Steve. I think it's next week. We'll start to see them.
I think TD is actually out today. So yeah, you'll see TD.
It was Kenneth Lay and Jeffrey Skilling.
Yeah, Skilling. I think
founders, and I think they ended up spending a significant amount of time in jail.
They did.
So You think there's a interesting dynamic here that's brewing as we're kind of touching on the Canadian banks, but we've talked.
Steve, March the 2nd is for TD. I don't think anyone's out today.
Okay, well,
Yeah,
see, it's the problem. I don't know what I'm talking about, but what I was kind of touching on with the Canadian banks obviously coming out is, we've chatted a lot in recent months about the private or sort of the gates being closed, basically the gates closing on a lot of these private mortgage funds. I think what we talked about really is this sort of default cycle that's really starting to pick up now. I think Romspin was one of the first that we had chatted about in the show. It was kind of the first big fund that, had gated investor withdrawals towards the end of last year in 2022. And, it's interesting because I'm reading an article today that, one of the reasons is they've filed for a lawsuit against this developer that they lent to, who's actually building seven towers here in Richmond, BC, where I grew up. And so that's in the court system. We had this Coromandel developer that in Vancouver that had about $1 billion in land assets. They blew up, a couple weeks ago here. And so you're sort of seeing this default cycle slowly picking up. And we had actually one, you're starting to see it in various segments. You see in the US. So PIMCO owned office landlord just defaulted on $1.7 billion mortgage. And obviously we know that, the office space, I think, is an ongoing concern given that the return to office just hasn't really got back to what it was pre-pandemic. So long story short is talking about all these, soft landings and everything. To me, at least on the real estate side, what I'm tracking is the default cycle, particularly more so in the commercial space, is definitely ramping up.
I can't add anything. All I can say is what I look at. We've talked about this before, which is bellwether stocks for housing. So bellwether stocks are like stocks that give insight into, well, for someone like me, who's not a bottom up guy, and not someone like Steve, who's on the ground, insight into what's going on in that specific sector. So if you're looking at tech, you might look at Apple and Microsoft and TSMC and Google or whatever. What's wild is that I'm looking at it right now, the housing bellwethers are all up. So Equitable Group, Home Capital Group, which was bought out by somebody, I think, Altus, Sleep Country Canada, and Ultra Mortgage, they're all up off their lows. So I have no idea what's going on either there, because I think you're right, Steve. I think that's the default stuff and all that. Maybe delinquency is probably a better word, more nuanced word, is starting to pick up. But yet the equities are telling you party on. So I that's all I have to add on that. I can't.
Yeah, and I think again, boots on the ground on the residential side. I think anecdotally, the people are out there buying houses.
Weird.
It's interesting because it doesn't really quite square with the data, right? So I'll just give you one data point. I'm looking at the US, and I think if you don't actually look at this with context, so the seasonally adjusted mortgage purchase application index in the United States fell 18%, I believe it was last week, to a reading of 147. And that is the lowest reading of this century. It's in the 2000s here. So over the past 23 years, it's the lowest reading. But if you actually anecdotally talk to realtors in the industry in the US and follow it closely, a lot of these houses are actively in multiple offers. The housing market is not collapsing in the US. There's the lowest level of inventory, I think, in 20 years there as well. So, and that's kind of what we're seeing here too. If you look at Vancouver and Toronto home sales figures, they're the lowest levels they've been at since 2009, just after the GFC. But if you talk to any home buyer looking for a house right now, good luck. Most of them are competing for housing right now. They're not driving the prices up to these, crazy bubbly levels, but they're competing on housing. It's a pretty tight market. So it's weird because it doesn't really square with the data, and you're seeing these on the commercial side, you're seeing these delinquencies starting to ramp up. And there's obviously these risks that are in the system, But like on the retail side, doesn't seem to think or care about, what a potential recession may or may not be coming, and that mortgage rates are still high, and the Fed and the BOC might still have to raise rents or raise rates. They're kind of just ignoring it.
And I think that's the key, right? I mean, as of right now, there's still no recession. Everyone is working and all that stuff. And if we do not get one, then, this will plod along until something else happens. And that's the whole theme right now. And I think, we've been pretty clear that we do expect, we can't have stall speed here. We're either going to accelerate again or it's going to come off. And we're leaning towards we're going to come off, because we know that these rate hikes have not been felt yet. But the biggest risk for Canada, it will come from outside of Canada. Something else can trip up the market here. And people say, well, how will that affect Canada? It would affect pricing on the debt market. That's what would happen. So all of a sudden you get this risk off moment. Canadian dollar comes down. Mortgage rates go up, credit spreads are going up, equities come off, you're not as wealthy as you think, all that stuff. But you're right, Steve, until right now, the macro data doesn't reconcile it bottom up, and because we don't have that recession.
And like, what is it? I know some people will put more weighting into this than others, but was it M2 growth for the last year in 2022? It was first time in 40 plus years it was negative for the year. I mean, I don't know. It's interesting. Like, you're like, oh, okay. Like, I guess it doesn't matter. Like, and I know, Rich, you might not agree with that as a metric to be watching, but to me, it seems, relatively important. People were certainly excited and talking about it when it hit, 25, 30% growth at the onsets of the pandemic.
I'm definitely keen on that M2. You always got to look at money supply. It's one of your most important indicators as far as monetary policy and liquidity. I think there's a boring technical answer, which is M2 includes the excess reserves that are held on the central bank's balance sheet that are liabilities, that are on commercial bank balance sheets. And as the QT continues, it pulls away from that M2. Because if you X out, which is a finance way of saying remove, if you remove that central bank chunk from M2, money supply growth has actually been okay. And the reason is because in the US, banks are extremely healthy. Loan to values were at 70-year lows. Bank lending, loans and leases were okay. Mortgage lending up until a couple months ago was okay. And commercial loans, were fine. And so that's where I'd push back on that M2, but it's like a technical kind of nerdy thing that you sort of got to be really, really clued into. I understand the headlines are great, but that would be my pushback. I know I'm probably in the minority in that, by the way, Camp, just for the record. But I think but be that as it may, you're right to point out that collapsing money supply, even including those central bank assets, is remarkable, especially to the level, I think, is also the other thing. So who knows?
I mean, it's interesting though.
It's tighter liquidity conditions. That's what that means, really. Sorry.
I think that's just a confusing market in general, right? I mean, that's the thing is like, when I ask you that, like, you have to be able to sort of dig into the weeds.
Yeah, I've spent a long time figuring. It took a long time. I know it's in a 30 seconds blur, but that took a long time to suss out and think about, and then do the chart, and then go back and go, did I get that right, et cetera, et cetera. So it is a confusing market. Hopefully we can help people figure it out.
So we took exactly 3 seconds to analyze that chart back at the end of 2021. Yeah, well, that's when it was at the peak and it was easy to come up. So the good thing with, because you can, by the way, you go to yardini.com, he provides all these charts and models for free, so you don't have to calculate it yourself. And the bottom line is that it's been plummeting straight down, which means there's less liquidity being offered, which makes sense because everyone's raising rates. A lot of places are doing quantitative tightening and stuff like that. And some banks are maybe not lending as much as before, but on a net basis, it should be coming down. So that's negative. The positive is that maybe it doesn't come down much more. Do you know what I mean? Like, you can only contract so far. And this is where we always come back to the narrative. Okay, what is the Federal Reserve doing? Are they going to pause? Because as soon as they signal they are pausing, then that means, the M2 growth, because it is a growth number, right? Year over year. Pretty soon it'll just flatten out anyway. Rich, that's because of mathematics, by the way. That's just the way it works. You have that happen. That's why everyone's just so focused on that. But again, that narrative changed over the last 10 days, and it's still creating this opportunity, for markets to do something a bit funny. I have a bit of a funny story for you.
Let's give a funny story to wrap it up.
Okay. China this week announced that they are banning U.S. audit firms from the country.
Saw that.
So they're no longer going to be allowed to audit, Chinese listed companies. And I saw that. I was like, well, it kind of makes sense. The Americans are kicking out the Chinese, and, you get tit for tat going on. But maybe this is where the recession starts. Maybe there will be a recession for accountants in 2023.
Grown.
Accountants are going to start like marching into the village square with their pencil forks. Does that make sense? I'm trying to be funny, of course.
Can't wait to invest in Chinese equities.
Can you imagine you get a bunch of like angry accountants storming the Capitol? That's something to watch.
So who's going to audit these
Thanks
guys?
for that.
Thud. Boom.
Who's auditing these companies then?
Well, they'll just be Chinese accountants firm.
No one.
State-owned Chinese accountants run by the CCP.
Mm-hmm.
I mean, make no mistake, China is a bastion of capitalism. It's just a weird one.
Would you still put your money there, Rich? I sure as hell wouldn't.
I would not. I don't think you're paid enough of a premium. I mean, just to give you an idea, banks in China pay a 10% dividend and are trading on a 6 times forward earnings. That's very, very cheap, and people still won't buy them. It's because there's shenanigans. Shenanigans there.
Well, if you have the risk of having your capital locked up, that's
right.
What that is. That's the story is telling right there. And if you're in a free market where you can there's extreme liquidity, you can get your money in and out whenever you want, and that's why America is so great. It's been so great for a long time of attracting foreign investment. People want to go there to go to school. They want to live there. They want to innovate there and all that. Governments screw up a lot of things over time, but when you allow capital the freedom to be mobile when it needs to be, then you're going to attract investment. Otherwise, you're locked in, and then you have to try to create your own capital internally, and that's when it becomes a bit of a struggle sometimes.
Well, it's a good place to wrap it up. As always, we appreciate your support. All we ask is that you continue to share this episode with at least one friend or family member. Continue to build the Loonie Hour community. If you got the time and you got the patience, we'd appreciate a 5-star review on Spotify or Apple Podcasts as well. And we'll see you next week.